Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome, everyone, to another edition of Real Estate 360 Live. For those of you familiar with our show, we recently, as of the last 2 years, we were on CBS Radio. We are a program and now a podcast that is broadcasting nationally, and that's kind of the reason why we converted from the radio to a podcast so more people could actually listen in, tune in. These podcasts are meant to be very informative. We're trying to give you, the most pertinent information in the real estate industry that we possibly can. We'll dissect and break down a lot of what's going on in the national media, what's going on in Washington, D.C., Congress, the Federal Reserve. We break down all of these things and let you know how that's going to affect your real estate market. Now, you will hear me talk a lot locally about the D.C. metro area. That's where I'm based out of. But we will dissect the national media, and a lot of the times we'll be able to let you know what the implications of that means for your areas, whether it's a metro area or maybe it's a rural surrounding area. We've got a lot going on the last couple of weeks, and I'm sure, today is obviously Black Friday. Thanksgiving was yesterday. I hope everyone had a fantastic holiday. Generally speaking, when we get around the holidays, things get a little haywire because the stock market, people are selling off their positions, and the mortgage market rates are traditionally getting worse. And we're going to go into that a little bit in more detail today. We've had a few frantic calls lately about, hey, interest rates are moving, and this is around the holidays. What should we do? We're going to let you know a little bit about the interest rates in the holidays, and also we'll dive into some other things, some the reasons for maybe why you should buy now versus waiting in the spring. Joining me on our panel, as he does every week, is Louis Carosano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's been cited in the media as a real estate industry expert in the Wall Street Journal, Forums, Wall Street, Fox Business, Smart Money, MSN, and numerous others. Louis, how are you doing today?
Hi, Ryan. I'm doing grand. How are you?
I'm doing fantastic. So I assume that your holiday was good, and then obviously not as long as you would have liked.
Well, of course. And yours?
Oh, the same. You always enjoyed at least having that grand meal, and I feel like yesterday you look at all the food that's laid out, and it's always interesting that, your eyes are always much bigger than your stomach is, and you pile all that stuff on your plate, and then you sit down at the table and realize you can't even get through the whole plate. It was my grandmother makes this, world famous potato salad, and I always seem to, scoop, 3 or 4 scoops of that on there, and that's, my only concentration. So, my mom ended up asking me, did you try the stuffing? Did you try this? And I never even got to it. But that seems to be the case every year. But, it was always a good time, and now we're back. Black Friday. I did want to kind of touch on that. They're already reporting that it looks like that, sales are going to be up for this Black Friday. I don't really necessarily put much stock in that other than the fact that there's more people out there looking for deals, right? So obviously in an economy where money is getting a little bit tighter, people don't have necessarily as steady a jobs as they used to, or they're struggling and still looking for work. Finding deals is a more important thing for them to concentrate on right now. I don't think necessarily that it's indicative that the economy is actually doing better than it would be in any other year. What is your take on that? And I'm sure you're going to see the media play on this quite a bit, that it looks like, well, wow, retail sales are up. I mean, this is going to be something else that's going to be another indicator to look at in the coming months. But what's your take on, Black Friday and then what you think that you can take from that?
It highlights the dire straits that our economy is in because it's based on 70% consumer spending. So the entire economy is kind of pushed towards consumption and not towards production. So you get these scenes where if somehow we consume more, borrow more, go to Walmart more, things are going to be better. It's the same case with housing. In order to get the economy going, we don't want to produce more. We just want to make the existing houses, worth more. So it's basically the Federal Reserve lowering interest rates, encouraging consumption, encouraging debt, and somehow if people take on more debt, consume more, break the doors down to Walmart, the economy is doing better. It's not. Because basically that's going to come to an end when, as we've seen recently, Ryan, where China's going to stop buying U.S. Treasuries, China's going to price oil in yuan, and the cheap goods from China will stop coming as a result, so we won't even have that aspect of the economy to rely on, that we can borrow money and go out and buy stuff, because that stuff's going to get a lot more expensive. So I place zero stock in it, and it's also a cultural decline. When you see people climbing over each other, drawing guns, getting into fist fights, crashing at gates to go and buy something, it's just not the right way to grow an economy or a culture.
Yeah, I do agree. I mean, it's, and you know what, another thing that I've noticed is it seems like every year, they're opening stores early and earlier. Like, it was just Black Friday. Now it's everybody's going to shop on Thanksgiving, right? So, to me, if the economy is not necessarily, if it was doing as well as everybody thinks that it is, then you wouldn't have to open up the stores on Thanksgiving. But they're trying to just create, to me, even more of a built-up demand by opening stores early to get more people anxious to go and buy these products. But yeah, I think that it's not any sort of indicator other than money is a lot more tight than it was before.
It's tight, and you're right, it's tight, Ryan, but they're trying to make it loose, and that's where the contradiction is. Yeah. That the reason it's tight is because the economy isn't doing well. So the way they try to make the economy do well is by artificially making it seem like money is easy. All you're doing is encouraging people who already took on too much debt to go out and spend more.
Right, to spend more
money that they don't have.
Yes, and probably, on credit cards and other things, which obviously they're going to have to pay back. It's not money that they've had that they've set aside in some sort of Christmas fund or something like that. We all know that. So, I mean, obviously this week we've watched, I don't know if you've paid much attention to this, I'm sure you probably have, but interest rates have been rising up again. Yep. This has been the trend. And, this is a historic trend as well, and I did want to note that when we get around the holiday season, whether it's Thanksgiving and then heading into Christmas and heading into New Year's, this is typically a time where we will see mortgage interest rates start to move up. Now, a lot of the reason for why that's happening is because a lot of traders on Wall Street, stock traders and bond traders, they're actually selling out of positions around the holiday time. They just want that comfort of knowing that they've gotten out of their positions and don't want to lose or gain anymore. And right. So they get out of their positions, which naturally is going to allow for mortgage rates to rise up a little bit. And we've seen that happening over the last week. From Monday all the way through now, that's what's happened. On top of, we also had a couple reports come out. We had the headline durable goods orders, which dropped a negative 2.0% versus the estimates of 1.9%. Now, while that was a low number, it generally didn't do that much because it was basically matching expectations. Now, the irony of these reports, and we talk about this every week, that obviously was a worse than expected number, right? But then all of a sudden, we have the initial weekly jobless claims that was 316 versus an estimated 330,000, which was better. So while we didn't get hardly any movement for the better for mortgage interest rates on the durable goods order, as soon as that jobless claim came in at 316 versus 330, mortgage rates just got so much worse, right? So what it's telling me is that, it's so much easier for this type of economic data to put pressure on mortgage interest rates and let them rise. But it takes a disastrous report for things to actually get better in our favor. And this has been a continuing theme over the last 6 to 9 months where we've seen the volatility in the mortgage rate market is very significant. We also had the Chicago Purchasing Managers Index, which came in at 63.0 versus the market expectations of 60. So that was better, which that report is just basically saying that anything over a reading of 50 shows that manufacturing and there's some sort of economic expansion going on. So that was to say that, okay, the economy looks like it's improving there. Then the University of Michigan's Consumer Sentiment Index reading hit 75.1 versus the market expectations of 73.5. So this was better than what the market was expecting. So all these things, coupled with the fact that we're we're in the holiday season, obviously interest rates have gone up quite significantly, and all the interest rate bond traders are saying, hey, you guys should probably lock in. This is going to be a continuing thing through the end of this year. Now, the $1 million question that everybody keeps asking is, okay, there's been a lot of articles out there. I believe Housing Wire was the one in particular that had said, they were writing an article basically, hey, when will mortgage rates hit 5%? A lot of people are always trying to predict where interest rates are going to go, and they're trying to force people off the fence, trying to make them a decision. Obviously, we have Freddie Mac and National Association of Realtors. They're all peddling, hey, you should buy now before interest rates go up. Now, naturally, Louis, you and I have been talking about interest rates rising for 2-3 years now, right?
Correct.
Obviously, we've got the Federal Reserve that's been manipulating the system here, and we've got interest rates that have been artificially low for an extended period of time, primarily because the Fed is backstopping this entire operation. They've been buying, some 60, 70, 80% of all mortgage-backed securities that are put out there. So they've been able to suppress interest rates for an extended period of time. I'm not sure how much longer, they can continue to suppress these interest rates, because everything that they've done, even with the continuance of this program, we're still seeing interest rates rising up, where I would have, what they wanted to accomplish was keep interest rates low. But the article went in to basically said, let's see here, the managing director and chief economist, Lindsay Piegza, pointed out that the Federal Reserve officials said they might reduce their monthly bond buying program from $85 billion in the coming months as the economy continues to improve. Funny, right, Louis? Because you and I have talked. You think that they could do this in the coming months. I feel that they won't reduce this tapering program. But no matter whether they do or they don't, we're still seeing interest rates rising right now. And, that's going to probably continue. I think that people that think that, that they're going to wait till next year and all of a sudden we're going to see that interest rates tick back down into the 3% levels, I think you're crazy. I really do, because I just don't think that that's a possibility where we're at right now. What is your take overall, Louis, on interest rates? Do you think the possibility of hitting 5% is in the near future? Many of the analysts have said that obviously sometimes in 2014, by the end of 2014, that they think that they'll be there. What's your take on it? Do you think that it's going to really, there's going to be a major attention paid to Janet Yellen and her policies once she takes her post there as Fed chairman beginning of next year?
Well, I think that eventually the Fed will lose control over their ability to keep interest rates low. If they want to go higher, they'll end up going higher. And you're right, and even the NAR is now talking about, or their economist is, interest rates being higher next year because they also see some creeping inflation coming into the picture next year. Before we finish up on interest rates, we didn't mention the pending home sales were down again last month for the 5th month in a row. And, of course, that doesn't look good for the economy when the economy's recovery is supposedly based on home sales. If pending home sales are down, there really isn't much of a recovery left other than people running around today and crashing the doors down at Walmart to buy stuff. But the spin on it was, well, pending home sales are down now 5 months in a row. But last month was really an anomaly because of the government shutdown, which is, a total nonsense. Because the Lincoln Memorial was shut doesn't mean that pending home sales go down. Somehow confidence is lost. They're blaming consumer confidence loss in the government being shut down. Well, that's ridiculous. I don't think people care about their financial decisions because the government is shut down. But anyway, that's what NAR blamed it on. Of course, they didn't have the government shut down the prior 4 months to explain away the pending home sale decrease. So we have a situation where home prices are up, but sales are down. And the reason for that is prices are up, so sales are down. You can't have a real recovery, based on no volume. Because if you take all the inventory out of the system and have it only very limited, of course prices are going to go up. But very few homes are being sold. And also, new home sales pending permits and so on. Permits are slightly up. The new homes being built aren't up as much, but we're looking historically at still half the amount of homes being built, less than half the amount of homes being built than we had being built 4 or 5 years ago. So the housing recovery is not really happening. I just want to make that point because that ties into, if we don't have a real recovery now, when interest rates rise, how are you going to have a recovery? Because whatever recovery we have now or have had in the last year, it's all been price-driven and interest rate-driven and investor-driven. If you take interest rates higher and you take investors out of the market, you're not even going to get price appreciation, and you're still not going to get an increase in the amount of homes sold. So that's where I think we are right now with interest rates. They're going to go higher, no matter whether the Fed tapers or not. If the Fed does taper, that's not going to. I don't think it's at some point tapering is going to be ignored by the market. Taper talk and whether they taper or not. Because even if they do taper, they're at $85 billion right now, which is the highest of all the QEs, QE 1, 2, 3, and 4 that we ever had. If they taper, they pull it back to maybe levels that we had a year and a half ago. So what? If the market collapses because of that, then they'll just reinstitute more QE. So my view is QE is a permanent feature of the economy. They may try to slip one in for size and see what happens, but I really don't think that they're going to be able to get away with not doing QE. And the other problem, Ryan, is with QE, it continues it puts you further down the road of never being able to stop. Because now they're talking about negative interest rates. In other words, you went from Greenspan's low interest rates, Bernanke's zero interest rates. None of this has worked, so now you have to go to negative interest rates. And at some point, Ryan, when do people say enough? When they have to pay to put money in a bank and be warned that, look, if this doesn't work, we're going to come and take your money? It doesn't work that way.
Yeah, I agree. You know, you brought up a good point with the existing sales report, and basically existing sales have been down month over month for the last 5 months. And mysteriously, those type of articles and reports are being buried, right? They're not really talked about anymore. They're talked about the day of, and they're not brought up ever again. Now, my question to you is, Louis, okay, so we know that really they've been really trying to push real estate, right? They've been pushing real estate for the last couple of years because when people feel like their equity's rising in the home, they get a good sense of feeling that the overall economy is doing well, right? So that's been their objective. Now, when you get a report such as existing home sales that comes out and is basically negative for the last 5 months, why would the stock market not completely tank on that news? Well, other than the fact that they don't have, they're just, you know, trying to remain in line with the Fed and their policies. But to me, looking at that for the last 5 months would make me sell out of every stock position that I have, because that's the last thing that they have to hang their hat on.
Yeah, but because it's not doing well, Ryan, and they keep it, that's the reason why they might keep interest rates low. And if interest rates are low, you know, that's good for the stock market.
Right.
So that's really the reason. You're highlighting the fact that the stock market is not tied into, in any sense of reality, how the economy is doing. It's tied into whether you can push stock prices higher by putting more money into the system, irrespective of how well the economy is doing. And what I want to get, Ryan, is your take on Bitcoin, because Bitcoin right now is worth, not worth, it's what it's priced at, $1,100, $1,200 a coin, when at the beginning of the year it was worth, I don't know, something like $30. And that highlights that people are looking to put their money anywhere but the U.S. dollar because of QE. It makes absolutely no sense that you would have a alternate currency that is just based on, okay, we're going to put out 21 million of these things, of these Bitcoins. We're going to create a trading system, a peer-to-peer network where we're going to trade Bitcoins, and you can buy these things, and the price is determined by how many people want them and how many people are going to hoard them. And people are choosing to buy Bitcoins on a speculative bet that this might work out. And basically, they're pushing aside the dollar in favor of a cryptocurrency, which is 100% faith-based and not even backed by legal tender laws, not backed by the force of law. It's just backed by what people want to believe it is worth, which to me is the height of a bubble, because not that there's not usefulness in a peer-to-peer payment system, but how much money are you going to pay for the ability to use it? And people are saying, well, because, you can do all these wonderful things. You can trade with somebody in China directly. The fees are low. Therefore, the price of the coin goes higher. That doesn't make any sense. That's like saying because more roads are being built, the price of a car should be more expensive.
Right.
And the people are rationalizing the speculation, but it's not based on any price discovery mechanism other than more people want to have Bitcoin today than they had yesterday, and it's based on the hope that they'll be higher tomorrow. And that's all driven by having this cheap money policy where if you put your money in the bank, it's going to be worth less. And if you continue to hold dollars, it's going to be worth less because they're trying to create inflation. Well, of course people are going to try to put their money somewhere else.
Yep. Yeah, I think that, and I've said this before, and you've heard me say it, there's never, ever been a fiat currency that hasn't at some point become extinct. And when you start to pay attention to Bitcoin and virtual currencies as a whole, when they're getting, the price of the value of these currencies are rising, and like you said, people are willing to take and invest in this type of currency with the risk that's associated with it, basically says that they absolutely have no confidence in the U.S. dollar,
right?
And that the demise of the dollar is fully in place, and it's only a matter of time before the dollar becomes extinct.
What they say, Ryan, is they claim that the U.S. dollar is a faith-based currency, so why not have your faith in something other than the U.S. dollar? And, you can't argue with that other than the fact that the United States can force you to use dollars.
Right.
But when people say, well, you know what, I'm going to choose Bitcoin. It's not backed by anything. I understand the risks of hacking. I understand that it's not tangible. It has no intrinsic value. But I'm going to buy it anyway because at least I can hold on to that, and they can't take it away from me.
Right. Yeah. And I believe, isn't it like major funding providers like PayPal accepting Bitcoin? I mean, a bunch of them are actually accepting Bitcoin. So when that starts to become more universal across the board, then more and more, what do you call that? Some sort of service provider that is funneling money from one to the next, such as PayPal. I mean, and the more and more of those that pop up, the more and more that people are going to have their faith in virtual currencies such as Bitcoin. And I'm sure Bitcoin is not going to be the only one. They were one of the first ones to start up, so I wouldn't be surprised if more and more of them start
there
up.
are more. There's Litecoin, there's NovaCoin, there's TerraCoin. But the other thing they're going to do, though, Ryan, is because the Fed and the dollar is so powerful, they can manipulate Bitcoin, and who knows if they're not manipulating it right now. Right now, it's not a viable currency because it's so volatile. When it goes from 600 to 1100, you really can't make a transaction with any certainty. You have to kind of like watch it to the second to get the price that you want in order to make an exchange. So what's going to happen is there's going to be an ETF with Bitcoin. And, once that happens, once you have an ETF and there's a certain amount of Bitcoins locked up in an ETF, just like they have a certain amount of ounces of gold locked up in an ETF, they can manipulate it. They can manipulate it lower. They can manipulate it higher. They can make it more volatile. And basically, they can subsume it into the entire dollar paradigm. And that's the danger. And then, of course, they'll come up with other cryptocurrencies. But basically, cryptocurrencies, Ryan, are no different than the Fed. They may say they're limited in how many they can produce. But from the beginning, they're inventing them out of thin air. They're saying we're only going to have 21 million. Okay, and then, Ryan, you and I can have a currency that only have 10 million.
Exactly.
And 700 people can have currencies that only have 5 million. But when you add them all up, the amount of cryptocurrencies that you can have in circulation are infinite, just like the Federal Reserve can print up infinite number of dollars. And that's why I go back to gold and silver. There really is, as an intrinsic value commodity, there's only so much of it available.
Right.
And real estate's the same thing, Ryan, right? That's why they call it real estate.
Exactly. And the irony of all this is that gold and silver prices have been remaining low, right? Well, and to me, I really feel like that the silver and gold have been manipulated.
They naked short sell it. That's how they do it on the paper markets. When somebody sells 5,000 contracts, 2,000 contracts, literally tons of gold in 30 seconds, they don't have that to sell. They're selling it, and they're not. If you did have that, you wouldn't sell it that quickly and in those amounts. You'd want to get a better price. When they sell it like that, it's designed just to knock the price down. Because Bitcoin, gold, silver, they are threats to the dollar. They can't have them rise.
Yeah, so, in talking about the dollar, and we just talked about existing home sales, and basically existing home sales being worse obviously gives a reason for them to keep interest rates low for an even more of an extended period of time, which goes more back to our point that the Fed really probably won't have any intentions of tapering regardless of what they say, because if they keep getting declining reports in existing home sales and new home sales, then what they're doing is not even working at all, so they don't have a choice but to ramp this up even further.
Right, it's not working as it is, so we have to do more of it to make sure it's not working.
Exactly, so we can continue to do more and more and more until, like you said, at some point, one would hope, one would think that this would just become an utter disaster and just blow up in their face. But it hasn't happened to this point, and the question is how long can they continue this scheme? I don't think really anybody actually knows. And I've kind of said, each and every show that I feel like it's going to go on until the end of Obama's term. But then with all the stuff that's going on with him, and see, this is where I find it so interesting, because the way that all this plays out, it's almost like a perfect story all the time. Like we have all these, things going against Obama right now, and Obamacare and the employment report, falsification of that report, all these things that are negative against him. But now all of a sudden we've got all these good economic reports coming out at the same time, which is trying to me, to take the light off of what was, the previous week, what we were focusing on. And don't be surprised that between now and the end of the year, we're going to get more and more positive reports with one or two of these negative reports that they just bury underneath everything.
Well, you just pointed out, Ryan, they're going to make a big deal out of it. The sales for Black Thursday were probably better than expected.
I've already seen the headlines. Matter of fact, one of them, the first one that I saw, let's see if I can pull it up here. Stores 1, Thanksgiving 0. Shoppers forsake the holiday to get bargains at stores nationwide.
Wonderful.
Shopping frenzy on Black Friday. We went shopping on Thanksgiving night. JCPenney shows signs of light on Black Friday. Target, Black Friday deals draw big lines. Toys R Us deals gone in a flash. Five Black Friday trips. I mean, what is this all about? Consumption, like what we always talk about. Debt-based consumption, which is what the media pushes.
Buying foreign products.
Absolutely, and if we didn't have the media pushing this, imagine if they were to say, something negative about shopping, and they create this frenzy where everybody wants to be a part of it. That's all that it really is. It doesn't mean that they
Ryan, what if they were to mention how dangerous it is to go shopping? Like they do. In other words, if they made it seem like you have a greater chance of getting killed on Black Friday than you do in a terrorist attack. They would never say that. They want you to be afraid of terrorism so they can spy on you, but they do not want you to be afraid of going shopping.
Right, exactly. And the irony of all this, what is this going to do? This is going to set the stocks up to go even higher, because now the economy is not so bad. Guys, look at all the money that people are spending. I don't give, a crap about how much money people are spending. What I do care is that people actually are spending this money with money they actually have.
Do they have jobs?
Exactly. They don't.
I mean, because they could be spending. I mean, you can spend your EBT card in a lot of these places, can't you? I don't know what that allows you to buy.
Yeah, you can spend it on a lot of different things. I think it's just minus alcohol and some other things. But, even still, the question is, are people spending, the money that's in their checking account that they're supposed to be paying their bills for the following month, right? What are they, or is this savings money?
Or are they not paying their mortgage and showing up at Walmart instead?
Absolutely. I mean, are they going out and buying the $400 PlayStation 4 or Xbox or whatever that may be? I mean, it's not like these big-ticket items are inexpensive,
right.
Regardless of whether they're
made in the U.S.
deal or not. Absolutely. Yeah. So, this will be the backdrop, that the storyline that we'll probably hear going through until Christmas, and say, hey, look, retail sales are up, economy is booming. That'll get us through the end of this year, right? So not much happens. Not much happens between Thanksgiving and Christmas and New Year's anyway.
But there is a Fed meeting, Ryan, and what's your prediction on what they'll do there?
Absolutely nothing.
Nothing. Well, what do you think the chatter will be at and around the Fed meeting, and what will the Fed president say after the meeting? Because, they always, after the meeting, try to talk up or talk down whatever they said in the meeting.
Oh, well, we already have jobless claims that just came back, so there will be that number that comes out again. So it'll depend on what that is. But that would give them the ability to say, hey, look, jobless claims are down. Looks like, people are spending money. Their consumer confidence must be up. So we're gonna keep our eye on this, and probably we'll consider tapering sometime in the beginning, the middle of next year. That's probably what they'll say. And
so
then
they'll throw out the taper bluff again.
They have to, and they have to put it in the sentence. In every breath that they take, they have to throw that in there. Because if they don't throw that in there, it basically doesn't allow Wall Street or anybody else to interpret what's going on. They want to keep everybody completely confused and off balance, and that's the only way they can do it.
Right. They can't admit that they're never going to not taper, that they're always going to keep QE. They have to make it sound like tapering is imminent. But they can't get too much into tapering, because if they talk too much about tapering, people will get worried that the stimulus won't be there to prop them up.
But just
they have done a masterful job, if you think about it.
They have.
Because this is 5 years, and you and I talked about it. If they said 5 years ago, okay, here's the first dose of QE, and it's going to last 5 years, no one would have put up with that. But they've been talking since 2009, and I have a YouTube video on 60 Minutes of Bernanke talking about this is temporary and we'll exit soon and so on. And that's what they say every year, every month. They're going to stop.
Absolutely. And here's the alternative. Could Bernanke ever go to the podium and say, guys, here's the reality. The reality is that we can never stop QE. And the minute that we stop QE, the entire country stops.
He did say
right?
that once. He didn't say QE. He said in June that he would not allow interest rates to go higher because the economy is weak, and if interest rates went higher, the economy would tank. He said that, and that's what set off the whole interest rate rise from June, when it went from the 10-year went from 1.6 to 3.0 almost, 3%.
Yeah.
But basically, that's the other bluff, that they basically said that we're going to keep interest rates low, irrespective of whether we do QE, and eventually we're going to stop QE, but we're going to keep interest rates low for the next 2 years. That's an admission that the economy is weak and cannot withstand higher rates. But the question is, can they keep rates low without QE? And you've said, and I've said, absolutely not.
No.
You can't just by fiat say rates are low, and the market says, oh, okay, well, the Fed says they're low, and that's what they're charging each other, so we're going to stay, we're going to abide by that. No, the 10-year, if the Fed isn't buying those notes and overpaying for them, no one else is going to buy them. Especially when China says, that's not even speculation, we're not going to buy them.
Yeah. Well, I mean, just check this out. We've got the Fed buying $85 billion a month right now when we have interest rates rising, right? So even with them buying the $85 billion, rates are still rising. They can't completely suppress them. They can keep them so that they don't jump from like 4% to 6%.
They can buy more.
Right, they can buy more.
If they want to drive them lower.
And don't think that this is out of the question here, Louis. I mean, if we continuously see these new home sales and existing home sales, if we continue to see these reports like that, I guarantee you that that's going to have to be a move that they make, because they don't have a choice. Like I said, I think that their whole goal is to drag this out as far as humanly possible. And we said, like you said, if we would have thought that this would be 5 years at this point, we would have probably been kidding ourselves. But at this point, who's to say that we can't get to 10? Nobody knows. I mean, because the thing is that Wall Street is completely oblivious. They have to be oblivious, even though they know what's going on. They just have to continue on with the charade that's taking place, because if not, they'd be losing money, because with all of the institutional buying, stocks are rising and rising and rising. So you wouldn't want to be caught with your pants down shorting the market right now.
Don't fight the Fed is what they say.
Exactly. So you have to continue on with this until the Fed chooses to do something different, which they can't.
It's the old saying, when you're in prison, you eat the prison food. Doesn't mean you agree with it, but that's what's being served.
And you don't have a choice, right?
Yeah, and you really, if you're in the market, being short the market, the only reason you'd be short the market is for one catastrophic collapse of the market. Otherwise, day to day, you get your clock cleaned every day, because for the last year and a half, the stock market just goes up.
So do you think that there's actually a potential outcome in the foreseeable future?
Yes.
Where we could avoid an all-out collapse?
No. What I was going to say yes to is that the Fed will continue doing what they're doing, and everything will be fine until something happens. And something will happen, just like with long-term capital management, you may have all your models based on some type of range where good things happen within a range and bad things happen within a range. But something bad is going to happen outside the range of what people think, and that just brings the whole thing down because it's so weak. The economy is based on just higher prices, not higher production. And if you think about it, just because stocks are higher doesn't mean they're actually worth more. Doesn't mean they have higher revenues, higher profits. And I mean real profits. I'm not talking about profits manipulated because they fire a lot of workers and they buy back their stocks, driving up the price per share. And therefore, it looks like they have higher profits per share. If companies aren't doing well, but their stocks are higher, shaving that price off the stock and shaving the price off of homes, they're still the same homes. There's nothing special about them. They're still the same companies, not really doing that well. They're just priced lower. Now your entire economy has a lower price on it, more reflective of what it's worth, not that much. And I think that's what's going to happen. And when that happens, you go into a very fast deflationary depression because there is no wealth effect, because that just all evaporates the minute the stock market crashes and people's home equity goes down. And that's when you have to wonder, what will the Fed do next? And you would think they will have learned their lesson and they'll lay off and allow the recession, depression to take hold for a year or so and cleanse it out. No way. They will double, triple, emergency down on money printing. Do you agree?
Absolutely. I mean, I don't know if any of you guys have read that book by Ron Paul in the Fed, but in there, and you actually talk about what inflation is, and the real definition of inflation is an artificial increase in the money supply. That's exactly what we have here, and the only reason that we haven't necessarily seen it in like major increases on the street level, we've seen it, but just maybe not as much as we should have already seen it, is because that these dollars are tied up in the stock market and everywhere else. They're not making it into the hands of everyday average Joes. If that were to happen, and remember when we proposed that they really wanted to help the economy, instead of giving it to big banks to do what they want with it, they would give it out to everybody, and like just individual people, like here's $1,000, but do what you want with it. If we did that, we would have inflation so far through the roof it would be ridiculous, right?
Right.
But that's not the case, and they know that. That's why everything is so controlled. It's so funny.
That's exactly, you use the right word, control, because if you gave it to people, strange things would happen out of their control. If
Absolutely.
you give it to banks, they can control what happens.
Because they basically, that there's these agreements, basically what they can and can't do with that money.
Correct.
And the funny thing is that if they really wanted to help the market again, the Fed could have set preconditions for giving them that money. They could have said, you know what, you're not allowed to invest this in the stock market, to prop the stock market up. You can only lend this out to individuals, to small business, because guess what, that would actually have some sort of effect.
But Ryan,
on the overall
why don't they do that?
Because they don't want to do it.
Why? But how do they get away with not doing that?
Oh, well, because the big banks control everybody.
Well, the big banks control the Fed. They're the shareholders of the Fed. So why would they put restrictions on themselves when they're going to print up money and give it to themselves? Why would you attach restrictions?
Yeah, and they keep, it's just a vicious cycle that we're going through now. But everybody is wondering why the banks get richer and richer and richer, is because this whole system is set up for that to happen. And it will continue to happen for.
Yeah, with a straight face, though, they tell you that they're helping you out. That's the old expression where the government breaks your leg and gives you a cane, and then says, "See, without the government, you couldn't walk."
Yep.
It doesn't make any sense that they claim with a straight face, well, we're really helping the economy here, and we've helped housing prices, and now we're going to help the labor market by printing up more money and giving it to the banks. And with a straight face, you look at it and go, yeah, that's it. So if you give money to the banks, someone's going to get a job. Even the banks are firing people.
I was about to say, well, they're not firing people.
Hiring at the banks are the compliance officers that have to pay the fine and figure out, and the lawyers to figure out how they can negotiate with the SEC.
I was about to say, how funny is it that the system that they've created is one where the banks continue to just invest in the stock market and reap the higher returns that they've been doing, but they're firing off to all their employees because they're no longer able to give out the amount of loans they were giving before, right? So,
Brian, did you hear about the J.P. Morgan disaster when they tried to do this kind of friendly social media event, Ask J.P. Morgan?
No, what was that?
Okay, so they had a day few days ago, ask J.P. Morgan any question you want, and they ended up having to cancel it because people were writing questions in like, I have mortgage fraud, LIBOR rigging, predatory lending, credit card abuse. Am I well diversified? They asked like, what's your favorite whale? They asked all these questions, and it was a disaster, so they just called off the event. What's funny is that the public opinion of, you talk about Congress being at 5%. The large banks are in the same lack of esteem.
Yeah.
And, and if they try to charge negative interest rates, at some point the system breaks down just because, and that's really what Bitcoin is all about. I don't like Bitcoin. I like the concept of alternative currencies and people can choose what they want. But the only reason Bitcoin has any validity is because it's basically not the Fed. And that's why you have people flocking to it. But at some point, Ryan, I think Main Street America will wake up to it. I'm not talking about Occupy Wall Street and these protest movements. When they go to their bank and the money isn't there, that's when people will wake up.
Right.
Like what happened in Cyprus.
Yep.
Where you put money in Cyprus. Now, Cyprus is not some banana republic, whatever you think of Cyprus. It's part of the EU.
Yeah.
It had a depositor insurance and all that other stuff, just like we have here. And they just said, no, well, Cyprus banks aren't doing well. They took all these bad Greek loans, so Greek debt on, and they just, they lost money. So sorry you put your money in here, and sorry that it's insured, but guess what? It's not. So you don't get it back. I don't think you can get away with that here.
Yeah, I don't think you can either.
And that'll be the event, I think, something like that, where it's not something that impacts a segment of the population. It's something where everybody, it could just be one bank. It doesn't have to be all the banks. One of the banks pulls that. Then I think that's when everybody talks about it. And that's when everybody realizes there's something wrong here. And that's when I think you have a collapse of the stock market.
Yeah, so the question is what time frame are we looking at on that one? And then how many major distractions will we have between that?
I don't think you can distract people from having their bank account lifted from them. Because now you're impacting. So far down the road. What's that?
I just feel like that's so far down the road.
Well, I actually don't, because if they have to, if you believe like you do, Ryan, that they're going to continue QE and increase it, that means that they are fighting off a deflationary depression, and they're going to have to go to negative interest rates.
And let's say that they do go to negative interest rates, how long do you think that they can? I mean, this is my whole point. It's like we think that they're out of bullets, they come up with something else, and so now people are going to be paying to keep their money in the banks, but they're going to say, what's my alternative?
Well, you're right. Initially, they'll put it in the stock market, and that'll cause the stock market to go higher.
Absolutely. And here's the thing. So we know that there's there's the big banks, but I always thought, if anybody ever wanted to get back to the big banks, why wouldn't they just take and pull their money from there and go to a credit union or a local small bank? If everybody did that.
Yeah, sure, but they don't. But Ryan, that happened. There was a movement to do that a year or two ago. It was in the Huffington Post. It was in a couple of other media outlets. They were talking about on a particular day, everybody would just walk into their bank, take their money out, and go to the local credit union. Just didn't happen.
Yeah, and I think it's because regardless of what people think about the big banks like J.P. Morgan, Chase, like the one you're talking about, where they have all these comments coming in, those same people probably still have their money with them. You know what I mean? They make those comments, but they still have their money with them. So
it's also because they don't really see an alternative, and until they're forced to have an alternative where they take their money from them, it's like being in an abusive relationship. You have to actually get clocked, I guess. I don't know. I mean, they actually have to take their money from them. I mean, they had all those fees they were charging after after 2008. They got rid of those fees because I think that people were starting to get annoyed and thinking about leaving. But I think they're going to have to take your money. And I think
that would create a war, in my opinion. You know what I mean? Stealing people's money would create a war, is what I think.
They steal it already through inflation, because right now we should be enjoying the benefits of deflation. Things should be a lot cheaper for us.
Absolutely. But
They say they have a 2% inflation target. We'd have deflation probably 10% a year for the last couple of years.
Yep.
They're making it more expensive for us. So if you have inflation on top of then outright taking your money, that's a problem.
Oh yeah, I agree with that 100%.
But the question is, when will people have had enough of that and cause them to move their money from banks, maybe move it into all these alternative currencies? Who knows? That's the biggest threat, is if people move money into alternative currencies, and then they could try to outlaw it all they want, but if no one wants to participate in a banking system where you're going to lose your money, then it's kind of difficult for them to force you to do that. I don't think we're anywhere near that, but I think if you were to take people's money, the average person is going to say, well, why do I even have money in this bank if you're going to take it? And this isn't some kind of, this is what they did in Cyprus, and this is where we're headed when you talk about negative interest rates. Negative interest rates isn't outright confiscation, but it basically says when you put the money in, you're going to pay a fee to keep it here.
Yeah. Well, I've already seen some of the banks, basically, like, who was it, like PNC or somebody, like they have a virtual wallet. Do you have PNCs up where you're at?
Nope.
Okay, so PNC Bank, I think they're based out of Pennsylvania or whatever, but they're here. They have like a virtual wallet, which is like an innovative online thing, the way you can move your money around and whatever. But they now have a thing where it used to be where you didn't have to have any balance in there. Now you have to maintain a $500 balance in there in order for that to remain free. But what that's telling me is exactly what you're saying. Eventually it gets to the point where these banks are going to have to start charging for you to have an account with them. But there will always be exceptions to the rules, and most of those exceptions will be small banks and credit unions that are willing to do whatever to get those clients. Or
they'll allow people with large amounts of money not to pay. But I even know, and if you have a business account, Ryan, you know this, they charge you if you put too much money in your account, I haven't hit that point, but it's in my agreement, that if you make too many deposits or you put over a certain amount, that there's a fee.
Yeah. Yeah.
For giving them money to hold that they're going to make money on, you have to pay them.
Yeah. Yeah, I think there's even some where, like, if you write too many checks, or if there's so many debits from your card, they have all kind of quirky rules about that. There's a fee for this and a fee for that, especially on business accounts. You're right.
Yeah, and you also mentioned a couple of weeks ago they had where you weren't allowed to take a certain amount of money out, and you weren't allowed to transfer it internationally.
Yeah, it was like more than $50,000 in a month or whatever, and I think that was J.P. Morgan that we spoke of.
What if you have 20, 30 employees? You hit that number every month.
Absolutely. Yeah, then you'd be, and to me you're automatically forced to move your money out of that bank.
But you can't do it all at once because they won't let you.
Exactly. I always tell people that they think it's funny. You ever try to go, if you had a couple $100,000 in a bank and you go in there and you ask them, can you get it out? They'll laugh at you.
And that's why I go back to Bitcoin. Not that I'm in favor of, but the one advantage is you can send whatever amount into whoever and whatever amount you want.
Yep, sure can. And like I said, that's the fact that that it's getting so much publicity and press right now, and there's more and more people that are willing to take that risk to invest in that type of currency or buy that type of currency. It's kind of a tale of the times that we're in right now, and I think
it's a canary in the coal mine when people are willing to just throw caution to the wind because they already know what the alternative is. The Fed is supposed to give you a stable dollar. You're supposed to be able to save with confidence, but if their banks are telling you, no, we're not going to let you save here, and we're going to take your money from you, and we're not going to pay any interest rates, any interest on your money, why would you have confidence in the dollar? They're telling you, get rid of it, spend it. Don't save it. We don't want you to save it. We want it out there being spent. Well, then why hold? Then there's no reason to hold dollars. There's only reason to spend them, and that's an inflationary mentality.
Absolutely.
If something is worth something, you want to hold it. It's supposed to be a store of value, a store of wealth. It's not.
Yeah, definitely. Definitely not much value in holding a U.S. dollar. That's for sure. But, well, this is something we'll have to keep our eye on. Obviously we've got a lot of questions that came in via Real Estate 360 Live in regards to mortgage interest rates. That's realestate360live.com for those of you who are listening in for the first time. That's our the website that you can go to ask questions. On the right-hand side, there's an Ask a Question button. But, a lot of people have been asking, they're listening to the podcast and saying, we hear a lot of the talk about interest rates and where you see them headed, and obviously everything is so reliant on the Fed and what the Fed does. Are there any other indicators that we can look at other than the Fed? And right now, the answer is no. I would love to say, that we had some sort of free market and where these economic reports and economic conditions that we have, you could pretty much tell one way or the other what was going to happen based upon those reports. But now we can't even rely on those reports, guys. So we're at a point in time where, yes, it's only the Fed that matters. We have to pay attention to what they're doing, what they're saying, and that's how we can kind of figure out where things are going. Now, we're 5+ years into this deal at this point in time. We've got more and more programs that are coming up, probably coming in the near future, only because there's really not an alternative, right? They can talk taper all they want, but I'm going to tell you that they're going to be increasing even more. They're going to be printing more money.
They have to.
They have to. There's not an alternative, and I'd love for anybody to tell me what the alternative is, because nobody has an answer.
The only alternative is to let it collapse. But why would the banks put a self-inflicted wound on themselves? If they can afford and they can print money to keep themselves on life support and continue to make money, why would they pull the plug on that?
They wouldn't. And
even a little bit. Why would they reduce their dosage?
Yeah, because
they're going to collapse. They might as well collapse after they make their money.
Exactly. Make as much money as you possibly can.
Of course. Make hay while the sun is shining, while you're controlling the sun.
And buy up assets internationally, right?
Right.
And as much as you possibly can, so it's no longer in dollars. You've got it in something else, probably real estate or whatever else you can possibly buy.
Right, and then it becomes the old thing that John Connolly said when they took the U.S. off the gold standard: it's our currency, but your problem. Yeah. So once the banks diversify out of, they can do the same thing. Who knows what other assets they have or what assets the Fed has? And wealthy people, they own art, they own gold, they own Bitcoin, they own tons of assets outside of just the normal currencies. But then the rest of us, that's what we're told that we're supposed to have. And we end up with the dollars. Not real estate, not gold, not silver, not commodities. Because the average person can't buy commodities. They're going to have an oil well, or they're not going to go out and buy an oil field. But that's what the ultra-rich are doing. They're buying hard assets. I can't go out and buy a Picasso.
No. I mean, how many people can afford a Picasso? Hardly anybody.
Yeah, but you go to these auctions. I don't go to them. But if you look at these auctions, there's plenty of people bidding on this stuff.
Oh, absolutely.
There's coins being sold for $3 million at auction. Coins, like 1789 Liberty Bust or whatever, some kind of coin. Someone could pay $3 million for that.
Those are rich are getting richer, and that's why.
Yeah, and they're better off holding something like that than having $3 million in a bank account.
Yep, absolutely. You have something. You actually can hold something in your hand that's not, to me, worthless. But
that they can abscond with, like Bitcoin. I've heard people say they don't want to get on a plane, but this is a big problem for a lot of people. $400,000 worth of gold. All right, they don't need $400,000 worth of gold. They got $400,000 worth of Bitcoin. It goes wherever they go.
Yep, they get where they're going, and they can do what they want with it.
But if they had $400,000 in a bank account, that could be seized.
Yep, absolutely. Yeah, it's going to be interesting, but for those of you out there.
The thing about a house, though, Ryan, if you have a home, that's a good thing. It's a lot harder for somebody to take your home from you. Of course, they can tax your property taxes.
They can tax you, and there's always eminent domain that they can take it from you if they feel that they need to take it from you. But
not on a wide scale. I mean,
exactly. Yeah, I mean, and at this point, like I said, we talk about this every week. Still getting a fixed rate mortgage sub 5%.
The right neighborhood, the right house.
Great neighborhood, right house, and you can lock in your home ownership costs for the next 30 years outside of the property taxes and insurance, obviously, homeowners dues and things like that. But you can at least lock in your principal and interest payments. It makes complete sense to do. So taking all this stuff with the Fed that we've been talking about, and if you're just looking at it just for where interest rates are today, it's a smart play if you're able to. If you're able to, you're willing and able to, you have a stable job, you've got cash, down payment. definitely makes sense. And we'll be having this conversation, Louis, for probably the next couple of years. So we'll definitely, our job is to pay attention to what the Fed's doing and being able to break this down for our listeners.
Ryan, I got a question for you. You've put up
Sure.
the podcast on Apple. How do people access those on iTunes?
Sure. If you guys just go to iTunes and on the search button, when you can search for podcasts, just put in Real Estate 360, and you can actually download those to your phones, or you can stream them right there on iTunes, and you can catch us live. We're here each and every week, and they'll be posted probably, give me about 12 hours or so, and the next one, today's show, will be up there. So definitely check that out. You can also check it out on Real Estate 360 Live. And if you want to get in touch with Louis, Louis, tell them where they can go to check out your blogs. Okay, you can also see the podcast. I put them up on YouTube on the Small Gold YouTube channel, and you can go to smallgold.com. And I have a story up there this week on Bitcoin. So if you go there, you can also contact me at smallgold@gmail.com. Thanks, Louis. I appreciate it. We'll be back in next week, guys.
Thanks, Ryan.
In the meantime, check us out at realestate360live.com. Take care.